One of them's trading 125. One of them's trading 285. If you were to buy this time spread, remember, if you're long time spread, you're long time. If you were to buy this time spread, you would be buying the Jan 2026 67.5 call and selling the Sep 67.5 call. The actual difference in price is going to be $1.60. If you look at, we can look at these prices: 285 on the Jan call and 1.25 on the Sep call. So the difference in these prices, if you were to buy this time spread, would be you'd be buying the 67.5 call in Sep. You'd be selling the Sep 67.5 call at $1.25, and you'd be collecting that amount of premium. And you're buying the Jan 2026 67.5 call for 285. Total debit is going to be $1.60 for this. What you have now is you are long the Sep Jan 67.5 call spread. Paid $1.60 for it. The maximum risk that you can lose on this trade is $1.60, or $160 per one lot that you trade. Now, here's the kind of hard part about time spreads. I can't give you an exact P&L graph of what a time spread looks like, because the options have two different expirations. If both of these options were in the same month, I could give you an exact P&L graph of what this was going to look like depending on where the expiration was for that month, because both of the options would expire at the same time. But if that were the case, this wouldn't be a time spread, would it? It would be a spread inside that month, usually called a horizontal, usually called a vertical spread, or some sort of, part of a condor, or, whatever it is, a straddle, a strangle, whatever it is. In that case, they both have the same expiration date. And so you can draw a P&L graph that tells you, okay, well, if the stock expires here, this option's definitely worth this, and this option is definitely worth this, and you can plot it on a Descartesian kind of graph. In this case, you can't really do that because of the fact that they have two differing expiration dates. Once you get to a certain point where the front month option expires, you still have the other option on. And so that can be a part that is somewhat confounding for people when they trade these. For that reason, many times when people ask us about time spreads, we always say that you can always take the entire spread off if you want. Meaning, if you're long that, July Jan 67.5 call spread, you can always quote that July Jan 67.5 call spread as long as both of those options are still alive and kicking, and you can sell that spread and take both of those legs off. That is certainly one way that you can actually manage this position. And particularly if, let's say, you paid $1.60 for it and it was trading 2.5 and you wanted to sell it, you can very easily quote that spread and sell that spread. And you would have paid $1.60 for it, and you would have sold it for 2.5, and you would have made 90 cents. But the hard part about this is that in many other cases, I can give you an exact P&L graph of what it looks like at expiration if they're in the same month. In this case, it's much harder to do. What we can do, however, is talk to you about the characteristics of what this looks like and how they might move over time. I want you to think about this.